Welcome to the Deep Dive, where we cut through the noise and get straight to the insights you need. This week is shaping up to be, well, one of the biggest of the quarter for investors. Really packed with stuff that could genuinely move the markets.
Absolutely. We're seeing markets hit these all-time highs, but, there are definite undercurrents of caution growing too.
Yeah, exactly. So are we looking at real strength here, or is it more of a fragile rally?
That's the big question, isn't it? We're definitely in a moment with significant potential for big swings, lots of critical events converging, needs a closer look.
Totally agree. So for today's deep dive, we're really going to peel back the layers of the July 27th DIYWallSt Weekly Recap Newsletter. Our mission really is to distill everything you, the motivated investor, need to know from that. We'll zero in on the big macro themes, try to understand what's driving the market.
And we'll get that crucial preview of tech earnings coming up. Plus, even some quick trade setups, specific stock picks to maybe watch.
Right. The goal is for you to finish this feeling well-informed, ready to navigate things with, a bit more clarity and confidence.
Let's dive in.
Okay, let's unpack this macro landscape first. It's a complicated picture right now. Trade, the Fed, sentiment shifting around. Looking back at the past week, equity markets, especially the S&P 500 and NASDAQ, just kept marching upwards, fresh all-time highs. What was really pushing that climb, even with some, mixed economic signals out there?
Yeah, it's fascinating how resilient sentiment has been, hasn't it? Despite some, like you said, less than stellar economic data points, the main drivers seem to be growing optimism around trade talks and actually some pretty reassuring commentary coming out of company earnings calls.
Really? So the earnings comments helped?
Yeah, it shows how powerful those positive signals can be. Almost overrides the immediate economic worries, at least for a while.
And a big chunk of that trade optimism, that came from the U.S.-Japan agreement, right?
Yeah.
That sounded like a pretty big deal.
Oh, it certainly was, more than just minor tweaks. The U.S. and Japan reached a deal, specifically lowered auto tariffs 25% down to 15%, but maybe even bigger, Japan committed to investing a massive $550 billion into the U.S., a new partnership.
Wow, $550 billion.
Yeah, so for you, the investor, it's not just about tariffs changing. It signals this deeper strategic move, potentially reshaping supply chains. And it definitely sparked hope for similar deals, maybe with the EU, South Korea, especially with that August 1st trade deadline getting closer.
Okay, so that's the trade optimism side. But you mentioned the economic data was more of a mixed bag. What did that actually look like? What should we focus on there?
Right, so while the trade mood was pretty buoyant, the underlying economic numbers were a bit more nuanced. We saw manufacturing data slowing down. The Richmond Fed numbers, the S&P PMI, both pointed to some weakening in that sector. That's kind of a red flag for industrial activity.
But it wasn't all bad news, right? Sounds like some parts of the economy were doing better.
Exactly right. There's a divergence. The services sector, in contrast, looked stronger. It kept its momentum almost like it's on a different track. And the labor market, still showing resilience. Jobless claims kept falling. That's 6 weeks straight now. That's a very positive sign for jobs, consumer confidence. The job market looks, pretty robust still.
What about inflation and housing? Any clear signals there that fit into this whole picture?
Inflation. Well, the June CPI, that's the Consumer Price Index, it stayed stubbornly above target. Core goods prices hit a 2-year high, actually. But the Producer Price Index, the PPI, that was cooler than expected. So a little relief maybe on the cost side for businesses.
And housing?
Housing's still facing headwinds. Affordability is a big one, ongoing issue. And tariffs. They're still hitting construction materials, components. That adds to the pressure.
You mentioned tariffs again. How are they actually hitting companies right now? Is it really impacting their bottom lines?
Mm-hmm. Oh, absolutely. This isn't just theory, it's hitting hard. The ongoing tariffs weigh heavily, especially on manufacturing and tech. Look at Tesla. They withdrew production guidance. Elon Musk himself said expect a few rough quarters, blaming tariffs and also the end of the U.S. tax credits.
Right, I remember reading that.
And GM, even though they beat estimates, they warned about Q3 tariff impacts being significant. Dow Inc., the chemical giant, missed earnings, halved its dividend, explicitly blaming tariffs.
Wow, have the dividend.
Yeah, and even Puma, the sportswear company, cut its 2025 guidance sharply, directly citing U.S. tariffs. It just shows how widespread this is across all sorts of sectors. Makes planning incredibly tough for these businesses.
And then, of course, there's the Fed. Feels like we talk about the Federal Reserve every single week.
Yes. Always looming.
The FOMC meeting, that's the Federal Open Market Committee. It's coming up July 29th. And there's been very public pressure, President Trump pushing for rate cuts. What's the Fed's actual stance amid all that noise, and what's really at stake for the market here?
Well, despite all that, very public pressure, Fed officials have kept up this cautious kind of wait-and-see approach. They're watching the data closely, not rushing. Remember, their dual mandate: stable prices, maximum employment. So, Chairman Powell's comments at this meeting, they're going to be absolutely critical. They'll shape expectations for future rate cuts, maybe set the tone for the rest of the year.
And how does that tie into the dollar index, the DXY?
Good question. The DXY, which tracks the dollar against other major currencies, it actually came down recently, as expected. But if the Fed doesn't make big cuts next week, or if Powell sounds more hawkish, more concerned about inflation maybe, we could see the dollar strengthen again. It's all about those interest rate expectations.
Okay, now this is where it gets really interesting and maybe a bit tricky for a lot of retail investors. The put-to-call ratio. For someone just trying to understand the market, what does this ratio actually mean? Why should we care about it?
Yeah, it's a fascinating indicator. Think of the put-to-call ratio as like a gauge of market sentiment, almost reading the subconscious of the market. So puts are options contracts you buy if you expect a stock or the market to go down. It's a bearish bet, or maybe hedging.
Right.
Calls are the opposite. You buy calls if you expect things to go up, bullish outlook. So when the put-to-call ratio goes up, it means more people are buying puts relative to calls. It suggests sentiment is getting more bearish, or at least people are hedging more against potential drops. It's like a quiet whisper of caution.
And the trend for this ratio lately, it's been climbing quite a bit, hasn't it?
It really has. The trend is telling. We saw it go from 1.36, then 1.51, 1.53, tiny dip to 1.48, and then a big jump to 1.65.
1.65. That's a significant move up.
Definitely. A clear rise in bearish bets or hedging in a fairly short time.
Okay, but here's the puzzle. How does that square with the fear and greed index? Because the newsletter notes that index is still way up in the greed zone. How do we make sense of those two signals pointing different ways?
Ah, yes, the apparent contradiction. This is where the nuance really matters. The fear and greed index at 74, that's well into greed territory. It seems to clash with that rising put-to-call ratio. But Baya's note in the newsletter, that's commentary from our lead analyst, Baya highlights this. The thinking is, this greed sentiment might stick around until we see small caps and the Dow Jones Index also make new all-time highs.
Okay.
So it suggests that while there's definitely hedging going on underneath, maybe by bigger institutions or more cautious players, the broader market isn't showing widespread fear yet. The headlines look good, but there's this sort of quiet anxiety bubbling just below the surface.
Right, like the surface looks calm, but there are deeper currents moving. Okay, so with all that complexity, macro forces, mixed sentiment, let's zoom in on specific levels, signals. What can help us navigate? The S&P 500, the SPX, it's at all-time highs. What are the key resistance and support levels we should be watching?
Okay, yeah, levels are crucial. Think of resistance like a ceiling, a price level that the stock or index struggles to break through. Selling pressure tends to show up there. For the SPX, the next resistance levels are pegged at $6,405, and then above that, $6,485. Getting through those would be a strong bullish signal.
And the downside? Where's the floor, the support?
Support acts like a safety net. Right, catches a falling stock. It's where buyers are expected to step in. For the SPX, the next support levels to watch are $6,290 and then $6,120. Those are the potential bounce zones.
And technically speaking, what's the sentiment there?
From a technical standpoint, the weekly sentiment for the SPX is noted as a cross-up from oversold. Think of it like a rubber band stretched down too far, now snapping back. It often suggests selling pressure might be exhausted and there's potential for a bounce or more upward movement.
Okay, and the dollar index, the DXY, we touched on it with the Fed. What's its trend and levels telling us now?
Right, the DXY. As we said, it came back down as expected. Its next resistance level is up at $98.50. Support is down at $95.40. And its weekly sentiment right now is actually flagged as oversold, which suggests it might be due for a bounce higher soon, especially if Fed expectations shift.
So let's try to connect these dots. We've got the SPX pushing highs but nearing resistance, the DXY looking oversold, and that put-to-call ratio creeping up. How do all these indicators together give us a better picture of what might happen next?
Well, weaving them together gives you that richer, multidimensional view, right? It's not just one signal. You see the S&P strength, but also the challenge at resistance. You see the dollar potentially ready to bounce. And you hear that whisper of caution from the put-to-call ratio. It paints a picture of a market that looks strong on the surface, yes, but there are signs of, let's say, vigilance and strategic hedging underneath. It's a reminder to stay nimble even when headlines are screaming all-time highs.
That's really helpful context. Okay, let's pivot now to something that always moves markets, especially lately: corporate earnings. And tech earnings have been, well, a bit rocky recently.
They certainly have. And why they've struggled gives us some clues. Take Intel, INTC. They missed expectations. But beyond that, the new CEO actually scrapped major projects in Germany and Poland, blaming trade uncertainties. That shows how deep these geopolitical risks are cutting into strategic planning now.
Yeah, that's a big move. What about Alphabet, GOGL? Their issues seem different.
Alphabet, Google's parent, they actually beat revenue expectations. That was good. But they raised worries about weak free cash flow. And that's not just them. Weak free cash flow has been kind of a theme this quarter across different sectors. Suggests companies are finding it harder to turn revenue into actual cash they can use.
And Tesla, TSLA. Elon Musk predicting rough quarters ahead. What was driving that?
Yeah, Tesla withdrew guidance. Musk's prediction seems tied mostly to those tariff impacts on their supply chain. Plus, the end of the U.S. EV tax credits is getting closer. Big external factors hitting their outlook.
And it wasn't just tech feeling this trade pain, right? We saw it elsewhere, too.
Exactly. GM warned about Q3 tariffs, even after beating estimates. Dow Inc., the chemical company, missed earnings and halved its dividend, blaming tariff.
Halve the dividend, yeah.
And Puma cut its FY25 guidance sharply, pointing directly at U.S. tariffs. It really hammers home how pervasive this is. It's a critical factor for investors now.
Okay, so with that as the backdrop, this coming week is really critical. The big four tech giants are reporting: Microsoft, Apple, Meta, Amazon. MSFT, AAPL, Meta, AMZN. Given everything we just discussed, mixed signals, recent stumbles, why are these particular reports so incredibly important right now?
Yeah, why these four specifically? Their earnings are going to give us absolutely crucial insight into the tech sector's overall health, its resilience, its growth outlook. With the trade tensions, the mixed economy, other tech players struggling, how these giants perform won't just be about them. It'll be a barometer for the whole tech sector, maybe even the broader market's health navigating these cross currents. Any guidance they give, it'll be watched very closely.
Absolutely. Okay, let's switch gears slightly and talk actionable ideas. The newsletter always includes some quick trade setups, so let's highlight a few from this week. Remember, these come with specific entry, target, and stop-loss levels. First one, Textron, ticker TXT. What do they do?
Textron, yeah, they're a multi-industry company, very diverse. They're involved in aircraft, think they're Bell helicopters, Cessna jets, also defense systems, industrial products, even finance. A big player in several areas. Okay,
and for TXT, the setup highlighted is buy near $74.60, target sell at $77.60, with a stop loss at $71.60. Next up, a name many will know, GameStop, GME.
GameStop, right. Focuses on video games, entertainment products. They operate through e-commerce, but also all those physical stores, GameStop, EB Games, Micromania in different regions.
Got it. For GME, the setup is buy near $22.75, target sell at $24.75, and the stop loss is $20.75. And finally, a major healthcare name, CVS Health, CVS.
CVS Health, a huge player in U.S. healthcare. They've got the retail pharmacy, CVS Pharmacy, the pharmacy benefit manager, CVS Caremark, and the insurance side with Aetna. It's a very integrated model.
Okay. And for CVS, the trade setup. Buy near $60.60, target sell at $63, stop loss at $58.25. Now, it's really important you mentioned the stop loss for each of these. Why is that specific price point so crucial when you're thinking about trading?
The stop loss is absolutely fundamental for managing risk. It's basically your preset exit point if the trade goes against you. It limits your potential losses automatically. Think of it as a safety net for your capital. If things don't work out as planned, it gets you out before the loss gets too big. It's just core to disciplined trading.
Makes sense. Okay, so let's quickly recap what we've covered in this deep dive. We looked at the big macro forces, the Fed decision coming, that August 1st trade deadline. We deciphered indicators like SPX levels, the DXY trend, and that rising put-to-call ratio.
Yeah, and we got that critical heads up on the massive tech earnings coming from Microsoft, Apple, Meta, and Amazon. Plus those specific trade ideas for Textron, GameStop, and CVS.
Right. The goal was really to give you that concise overview from the DIYWallSt Weekly Recap, arming you with the key knowledge for the week ahead.
hopefully equipping you to navigate these pretty dynamic markets.
And to leave you with something to think about, here's our question of the week. With trade tensions still simmering and Fed policy right there in the spotlight, how do you think these factors will shape market sentiment in the second half of 2025? Will AI and tech keep leading the way? Or are tariffs and geopolitical risks going to create bigger headwinds for growth? Think about how you'll interpret the data coming in. That's where the real insight is.
Yeah, really mull those over as you watch things play out. Look for those connections.
And if you want to dig deeper, share your own thoughts, connect with other investors who are thinking about this stuff, join us in the DIYWallSt Discord. You can trade smarter together there.
Definitely check it out.
We'll see you there.